Hello and welcome into the KE Report. Shad and Corey here as your host, and today we're getting an update from our friend Doc Jones. Doc Jones is a private activist investor in the resource space, and it's always great to get your take on what the trends are in the space, Doc Jones, but also what companies have your attention. I know that you do a lot of research and due diligence, and happy when you share it here with our audience. So let's kick it off with the precious metals. Both gold and silver
hmm
have been having some good rips higher. We've seen gold hold at a steady price well above 3,000, really in the 3,300, 3,400 range, which gives producers amazing margins. It gives developers fantastic economics. And then if you find more gold, obviously it's a boost to explorers. And then silver also coming up and showing some life and getting above 35 and breaking a little higher. So when you look at the precious metal space, how are you looking at it in a general sense, Doc Jones? And then what companies have your attention?
Hey, Shad. Nice to talk with you again. Yeah, it's really a fascinating time to be involved in the precious metal sector. We just had for the first time in a very, very long time where gold has become the second largest reserve asset for European central banks, which is very interesting. And gold now becoming a tier one asset again, it's put a lot of demand from central banks there. And you look at the macroeconomic backdrop here, we're at a position where, let's say, the Fed doesn't cut rates. Well, then the US has to roll over the short-term debt at much higher rates, which will exacerbate a recession, which causes people to go into gold at some point. They do cut rates, then you end up with inflation, lower yields, gold becomes more attractive to investors. And that you get some of that bid comes into silver as well. So I've been looking at a few companies. I don't know, people follow me along. My portfolio's probably expanded the most it has in the last 5 years, where I'm holding, I think, 16 or 17 names now. But within that, they're not equally weighted. And the majority of the portfolio, over 80%, is within five companies. It's there are some really great stories out there. It's interesting. You look at there's a lot of private placements going on now, and you're seeing where companies are not breaking through the placement price, where they're actually rallying on the news of a private placement, which goes to show you the sentiment of investors right now. Omai Gold, which has been in my portfolio for a long time. I think I first talked about it on the show here about 20 months ago at 6 cents. It's now hit an all-time high, close to 60 cents now. And they're really doing wonderful work there. They have a resource update coming out. And I had a meeting with management, and I was talking to their head geologist and just getting an idea on Gilt Creek, which is that underground deposit that's next to the Wilmette pit. And one of the statistics they threw at me is that they have 4,600 ounces per vertical meter there, because it's this big blob of mineralization about 350 meters below the surface. It's like 100 meters by 300 meters, perfect for like bulk underground mining. And that statistic was just startling to me. I was like, that's amazing, because, tons per vertical meter, they mean a lot to the economics of a project, which enables you to either mine a lower grade than, say, in Red Lake, where they're doing narrow, high grade vein mining, where they're getting, 6, 7, 8 grams per ton over 2 meters, or something like that. Whereas this, I think it's 3 grams per ton, and the average width there is like 50, 60 meters in that area, and it's very homogeneous too. So your all-in sustaining costs would be equal to, or probably lower than, some of the high-grade narrow vein mines that are out there in the world. So yeah, that's really interesting. I like that. And also silver, I remember you and I had talked in the past. I'd always kind of not had an affinity for silver, and I stayed away from silver investments. But for the first time in many, many years, I've started deploying capital in silver juniors. One that I've recently participated in a placement, and then upon them answering an unanswered question I was waiting for, I increased my position pretty substantially, which is Excellon Resources. They've got the Mallay mine in Peru that's on care and maintenance. They picked this asset up at 600 ton a day mill. All the infrastructure is there. The Buena Vista spent 110 million US to build this thing. They picked it up for a song. They've got about 2, 3 years production left in it on the historical resource, but there is upsides to extend that another 5, 6, 7 years, and they will generate at $30 silver. There's about 25 million in cash flow US. Now, this is for a company that is currently 24, 25 million US. So basically, the cash flow will equal the current market cap. And within that, which is really interesting, is they recently, what got me excited and to go into the market and pay 30-40% more than in the placement, was they signed an offtake and financing deal with Glencore. So they're fully financed to get into production, which should happen towards the end of this year. The mill will start receiving feed, and by early 2026, they'll get to nameplate production of 600 tons a day. So that's really interesting. I like that. The silver, I think, has a good shot of getting up to $40 an ounce at some point in the next 6 to 12 months. And if we sustain a 25, $30 an ounce long term, I think companies like this, for example, will make a lot of money because the production profile is about two-thirds actual silver and one-third high-grade base metals, zinc and lead. So I think that's a good place to be. Plus, they have their Kilgore project, which they bought years ago for 20 million US. Got 1 million ounces of oxide gold. Strip ratio is only 1.1 to 1 there. The capex there originally was about 80 million. So if you throw a 50% on that, 120 million, the NPV on that at 3,000 gold is 700 million US, which is incredible. And still, we're talking about a company that has a market cap of 25 million US. So I think there's a lot of optionality there, lots of upside. It's in Idaho, so that can be challenging to work in, but I think under the current administration, that could be something that they could get into production in, after Mallay is up and running, and look at redoing a PEA in 2026, as well as issuing a new resource on there using a lower cutoff grade, obviously, because when they did it at 1,300 gold. So we are $2,000 above that. So there'll be a bit of resource that we'll pull in there. So yeah, that's what I'm getting excited about.
So more so on the silver space, I'm curious what you're seeing in the big picture here, because Excellon, it's a great example of what we have seen broadly in silver stocks is over the last 3-4 weeks, maybe stocks have started to move up. We've seen higher volume come into the silver stocks, but there's still so many of these that are really coming off some very low prices. There's also a lot of these silver miners, smaller silver miners out there that are also starting to get some traction. They're also starting to make some money. So how are you trying to filter through the small silver miners, these silver developers, and then the silver explorers? They're all starting to re-rate here, but where do you see the sweet spot being for investors?
Well, I think the sweet spot for me is in the developers and the producers, because I think that's the area where I'll lose the least amount of money if I'm wrong, because they will have cash flow. And the current forwards on silver futures pretty much guarantees that they will maintain profitability. And in some cases, you'll see companies that are in production, they'll warehouse the cash. They will be debt-free if they're not already, and use that cash to redeploy into other assets that provide better margins, perhaps, or a different commodity. And if you're dominantly silver, maybe you use that cash flow to pick up a gold asset or a base metals project. The explorers, well, that's your high torque, high risk. So for me, like, people will see that I'll post, I put some money in this company. Chances are it's like 0.1% of my total net worth. Could be, right? So all my positions are never weighed equally. It still is hard because there's a lot of junk out there. There's a lot of companies that their share price will go up, but it doesn't mean it's a good company. So you really have to do your homework. You gotta look at if they have a previous PEA, look at the resource, look at the management team and the jurisdiction as well. So it's tough. Like, we get these bull markets and prices explode. So sometimes it's alluring to run all your numbers at the highest price possible, like the prices today. With a gold company, for example, I would suggest you run your numbers at 22 or $2,500 gold and see if it still generates an attractive margin. Same thing with silver. Look at something that between 22 and $25, it should still generate really robust margins. If not, then it's probably not the project for you. With silver in particular, it's very rare that there's just a silver producer. Usually it's tied up with base metals. So you have to model out the prices of all the commodities involved there of the concentrate. Like, for example, Excellon's going to be producing two concentrates, a zinc and then a lead silver with a little bit of gold that will go to Glencore. So you have to have an opinion, therefore, on what zinc prices are going to do, because it's probably going to account for 20% or 15% of revenue, as well as lead. Right now, looking at zinc, you look at the treatment charges, they were negative last year, which was smelters were paying for the concentrate. It was negative, got as low as negative $40 a ton of concentrate. Now they're about plus $35 a ton, which is still low historically, which means that there's high demand for zinc concentrate. Exactly the same thing's happening with copper right now. Copper concentrate, the treatment charge is negative. So you sell your concentrate and they actually give you additional money on top of the value of the metal that comes out of it. So that gives you an insight as far as how the supply demand picture is out of whack and in favor of the producers. Whereas when treatment charges are extremely high, it means there's an abundance of concentrate and the smelters are overwhelmed, and only the best grade, the tons that generate the highest margin, survive in that environment. So yeah, with silver, it's not easy. It's not easy because very rarely is it just producing silver. And silver markets tend to boom and bust a lot quicker than any other.
Yeah, that's a good point, Doc Jones. It's the heartbreaker metal for a reason. It goes up, it goes down, and it's usually not a pure silver play. And to the point you made about copper, there are some pure copper plays, but there are a lot of polymetallic companies that also have a range of other critical minerals. So let's maybe shift there next. Like, I know you like copper, but there's a lot of copper companies that may come along with zinc and silver and lead in there, and they may have other, they may have nickel along with it. So when you're looking at the range of critical minerals and strategic metals, what has your interest?
Primarily copper at this point. Nickel is not far behind that, but it'll be a few years before the nickel market recovers to where that will be a primary source of revenue for the companies that I'm interested in. For example, Magna Mining has been a stellar performer, and I'm not just talking, share price. It's, at all-time highs. I think when we first talked about it on the show, it was around 25 cents. Now it's, I think, $1.80, $1.85, something like that. But what's really great about them is management execution. These guys have done the most unbelievable job. And then Sudbury, what's great about Sudbury is the zonation of the mineralization there. So you have the footwall, which is predominantly copper and PGMs with a little bit of nickel. And then the contact ore, which is predominantly nickel with a little bit of copper and PGMs. So they're mining specifically the footwall now at McCreedy, which they've just acquired recently. They've had it for, I think, 3 months now. They reported their first quarter recently where they had 1 month of ownership and produced positive cash flow, which was very, very interesting for them. And the grade there is phenomenal. So those guys are doing great. We've talked about this before. They exist on 2 points in the Lassonde curve. It's like a cork, right? They exist in 2 places on 2 dimensions. They have this very deep exploration portfolio, as well as they are getting the re-rate of a producer because they just acquired the mine, took possession, are now optimizing and plan to grow that production there from 900 tons a day towards maybe 1,500 tons a day by mid 2026, as well as optimizing the grade above to where it is. And I think why the market has paid attention is not only because they're in production, they've been releasing some production drilling assays, which means this is stuff that's going to be in a mine plan in the near term. And the grade is vastly higher than the resource grade that they inherited from KGHM, which margin is everything, They're going to make a hell of a lot of money on that deposit because you have copper now that's well north of $4. They originally did their study, I think, at $3.50. So, and PGMs, we have platinum and palladium picking up, especially now. If you saw today where President Trump is rolling back the EV mandate of California, then the secondary effects would be, well, there'll probably be more demand for internal combustion engines, which means that the demand for platinum and palladium should increase over time a lot greater than was originally thought, which is good for platinum palladium prices, which are already in a deficit as far as supply. And what the US does, other people follow. So it's a good place for Magna to be. And then on the other side, polymetallic, we have Emerita Resources, which, recently announced their updated metallurgy, where they're capturing over 80% of the gold in the IBW, which is a big deal because in the byproducts, they have 1 million ounces of gold and 50 million ounces of silver and a few billion pounds of lead, zinc, and copper combined. And that project received a distinction of strategic importance to the country of Spain. This is outside of the court case, which is more, I can't speak on that as far as, what the outcome of that is. As far as what is factual, they have a project. They've got over 20 million tons there. They have government support, and those deposits are at surface, near surface, ramp access, lots of infrastructure. So the NPV on that, once they do the PFS later this year, should show a pretty robust CapEx to NPV. So that's how I'm playing that.
Let's also look to the energy sector. We do usually talk with you about oil or natural gas stocks. And look, natural gas still at an okay level, right around 350, although it hasn't really done much in the last almost 3 months now, even 4 months. Oil, that was under pressure. That was below $65 a barrel. Has recovered now to about 68, so a little bit of a rebound there. But still, there doesn't seem to be this as bullish narrative right now around energy stocks as there was a couple of years ago, or let alone what precious metals are like. So how are you viewing energy stocks right now?
Well, there's a stealth rally going on in natural gas producers, particularly the ones in Canada that are predominantly, or the majority, or all their production in natural gas. Like you've got Birchcliff and Peyto, which are two of the mid-tier, I guess you would call it, producers in Canada. Each one of them doing around 100,000 barrels a day of oil equivalent, primarily all natural gas or natural gas liquids, mainly all dry gas. But they're both doing extremely well. Like Peyto is now at an all-time high. It's a little over $20. You go back 5 years ago, this company was at $1.60, $1.70, and now they're paying a dividend equal to almost your initial investment had you bought it 5 years ago. But I think the big story here is that we're getting more LNG export capacity. You have the Permian Basin, which is rolling over in production, so you don't get the same associated gas, and the demand keeps increasing for natural gas. So it's a good place to be. There's the forward pricing on Alberta gas. Right now, Alberta gas, I think, is $1, $1.10, something like that. But the forward pricing going 3-4 years out, starting next year, you get into the $2.50, $3 an MCF, which is very profitable for those Canadian producers in the Deep Basin. And as well as the NYMEX gas, the forward curve on that is looking very attractive too. So natural gas is, if I had to pick oil or natural gas, I would stick with natural gas. Oil is iffy. You got a lot of geopolitical risk out there that has added probably $5-6 a barrel recently. But if we go into a deeper recession, I think we're in a recession now, then you get demand destruction. Plus you have OPEC that's adding barrels to the market. But you're also seeing declines in production in the United States. And I thought, had we got a different government in Canada, conservative government versus liberal, there would be more proactive in increasing production in Canada. But with the liberal government, they've always been somewhat anti-fossil fuels, capping production and emissions and things like that. So you have all these cross currents where one is canceling out another. So it's hard to model where I see oil going. I had a clearer picture, 6 months, a year ago, but I've had to change my mind about it. Right before the Liberation Day, I had a thought that it might be worse than people thought. So I cut my oil exposure in half. And now I'm waiting because the equities did fall 20-30% after Liberation Day, and now they've repriced to about where they were prior. But if we see a recession, a decline in oil prices where we do get below $60 a barrel, I think there will be some very good opportunities to pick up some income generating assets, especially in Canada. Like the Canadian oil producers are at such a discount to their peers in the United States, which are trading at a discount historically anyways. So if you're looking for sensational returns, I wouldn't recommend it. But if you're looking for income, like they're very tax efficient, and you've got income that production that is primarily 50 to 70% hedged, providing secure cash flow to pay dividends that range from 8 to 11% in the oil and gas sector. So for those just looking for a stable source of income, particularly in Canada, because the dividends are eligible, which means you get taxed at a very low tax rate, like at around 15%, 12%. So that can mean a lot, to someone who's looking to generate income in retirement or on the side while they're working, and they don't have the time to do all the research and delve in juniors and the high risk markets that are out there. Then why not generate a little extra income that is 2x the 10-year?
Well, I think we'll wrap it up there for today, Doc Jones. But it's a great point. Sometimes it just pays you to wait in the stocks, like the energy stocks, and have an income while you're waiting for the sector to re-rate. I was going to ask you if you favored nat gas over oil, but you covered that. And I was going to ask you
Yeah.
U.S. versus Canada, but you covered that. So that's a good spot to wrap it up. I appreciate you breaking down some of the companies you're looking at in the precious metals and the critical minerals
Sure.
and in the energy patch. Let's do this again sometime soon. And for those of you interested in following Doc Jones, you can follow him on X/Twitter or at CEO.ca. I'll put some links down below so you can follow along with the companies that we didn't even get into today that he's got on his radar. And appreciate your research, appreciate your mind, and just thanks for sharing with our audience the companies on your radar.
Yeah, my pleasure. And I wish you both a great day.